Imagine a world where agreements are executed automatically, without the need for intermediaries. Picture this: you're selling your car. Instead of haggling with potential buyers or relying on a middleman to finalize the deal, you simply set up a smart contract. This digital agreement, coded onto a blockchain, stipulates the terms of the sale: the car's price, transfer of ownership, and payment method. As soon as the buyer sends the agreed amount, the contract triggers, transferring the ownership and releasing the funds, all in real time. No delays, no miscommunication, just a seamless transaction. But what exactly are these smart contracts? In essence, smart contracts are self-executing agreements with the terms of the contract directly written into code. They run on blockchain technology, ensuring that once deployed, they operate in a tamper-proof environment. This means that, like our car sale example, once the conditions are met, the contract executes automatically, enforcing the agreement without human intervention. Currently, smart contracts are being applied across various industries. In real estate, for instance, they can manage property transfers, ensuring that when a buyer pays, the title is automatically transferred without the bureaucratic delays typical of traditional processes. Similarly, in the supply chain sector, smart contracts can automate documentation and payments as goods move along the logistics chain, reducing fraud and increasing efficiency. The implications are profound. As we reduce reliance on intermediaries, we also lower costs and streamline processes. However, this raises questions about trust and oversight. What happens when a smart contract encounters a situation it wasn't programmed to handle? Who is responsible if something goes wrong? While the technology is promising, it also necessitates an examination of the balance between automation and the human oversight that ensures accountability. As we venture deeper into this landscape, we must ponder: how can we ensure that these contracts operate fairly and securely? In a world where agreements can be executed instantly and without intermediaries, we stand at the precipice of a revolution in how we think about transactions. So what would happen if we embraced this technology fully? Would we be more efficient, or could we inadvertently create new vulnerabilities? As we explore the potential of AI to enhance these smart contracts, we must navigate these questions carefully, weighing the benefits against the risks. Imagine a world where a single AI agent orchestrates the entire process of buying a home, navigating the complexities of real estate transactions seamlessly and effortlessly. What if, instead of dealing with a real estate agent, lawyers, and banks, you simply interacted with a sophisticated AI that understood every nuance of your deal? This AI, let's call it HomeBot, would autonomously manage everything from the initial offer to the final paperwork. HomeBot has access to a vast array of data: market trends, property history, and even your financial situation. It evaluates these factors in real time, ensuring that you receive the best possible deal while adhering to legal requirements. This scenario leads us to wonder: would you trust an AI to handle such a significant transaction? The strange consequence is that by relinquishing control to an AI, you could potentially streamline the process, reducing human error and expediting decisions. But is that enough to ease your concerns? In this hypothetical real estate transaction, HomeBot begins by analyzing the local market and identifying properties that match your criteria. It examines everything from square footage to neighborhood safety ratings, automatically generating a short list of homes that fit your needs. Once you express interest in a property, HomeBot initiates a smart contract, a digital agreement that outlines the terms of the purchase. Unlike traditional contracts, this smart contract is coded on a blockchain, which means it's secure, immutable, and transparent. All parties involved, the seller, the buyer, even the bank, can see the terms and conditions, eliminating ambiguity and potential disputes. As you proceed, HomeBot conducts a thorough background check on the property, cross-referencing public records for liens, zoning laws, and any pending legal issues. Imagine the peace of mind you'd feel knowing that a diligent AI is combing through mountains of data far quicker than any human could. And when it comes time for negotiations, HomeBot employs advanced algorithms to propose fair offers based on comparable sales in the area, ensuring that you don't overpay. This AI can even gauge the seller's motivations. Are they eager to sell quickly, or are they holding out for a higher price? By interpreting these subtle cues, HomeBot enhances your bargaining position. Once a price is agreed upon, the next steps unfold rapidly. HomeBot coordinates with title companies, inspections, and financial institutions, managing the entire timeline of the transaction. Payments are made through another smart contract, which automatically releases funds to the seller once conditions like a successful inspection are met. This level of automation not only speeds up the buying process, but also minimizes the chances of human errors that can delay transactions. However, the question arises, what happens if something goes wrong? What if the AI misinterprets data or fails to account for a crucial detail in the contract? This concern highlights the delicate balance between automation and oversight. Real-world applications of AI in transaction management are already emerging in finance and logistics, where algorithms analyze vast data sets to optimize operations. For instance, in supply chain management, AI predicts demand fluctuations and adjusts inventories accordingly, demonstrating its capacity to manage complex systems. Yet, as we ponder the implications of AI agents like HomeBot in real estate, we must consider who benefits from this technology and who stands to lose. The potential for efficiency and accuracy is enticing, but what safeguards are necessary to ensure accountability? As we envision a future where AI agents autonomously execute contracts, we must grapple with the ethical ramifications of such power. Can we trust these systems to act in our best interest, or do we risk relinquishing too much control? The answers may redefine how we perceive trust and oversight in transactions. As we move forward, let's contemplate the transformative potential of AI in managing complex agreements, weighing the benefits against the risks, and considering what a future dominated by AI transaction managers might look like. Imagine a world where legal agreements are not just written and signed, but executed by an autonomous entity, an AI. Picture this. You enter into a contract for a new home, but instead of meeting with lawyers and real estate agents, you simply engage with an AI that manages the entire process. This AI, equipped with the ability to analyze vast amounts of data and access numerous legal precedents, executes the contract seamlessly. But as we step into this future, we must confront a pressing question. Could the very autonomy we seek from AI lead to unforeseen consequences in our legal agreements? What happens when the decision-making processes of these AIs are placed above human oversight? The ethical dilemmas surrounding AI and transaction management are profound and multifaceted. Imagine, for instance, an AI that interprets contract clauses differently than intended, leading to a significant financial loss for one party. The strange consequences that we might trade efficiency for accountability. When we rely on AI to manage our transactions, we risk creating a system where the nuances of human judgment are overlooked. To illustrate this, consider a scenario where an AI defaults to its program parameters, executing a contract without the flexibility that a human negotiator might provide. What happens if the contract was based on an incorrect assumption, or if the market conditions change drastically after signing? The potential for error escalates when we factor in the complexity of legal language and the variability of human intentions. This leads us to the necessity of regulatory frameworks. Just as we have laws governing traditional transactions, we must establish guidelines that hold AI accountable for its decisions. But what would these regulations look like? Who would be responsible when an AI makes a mistake? Should there be an oversight mechanism, perhaps a human-in-the-loop system, that ensures AI decisions are reviewed before execution? Imagine a regulatory body specifically designed to oversee AI-managed transactions, equipped with the expertise to interpret complex algorithms and their implications. Yet, this raises another dilemma. How do we trust those in charge of regulating AI? If the regulators themselves lack the understanding of AI's intricacies, how can we ensure the safeguards are effective? The need for transparent algorithms becomes paramount. We might demand the ability to audit these AI systems, ensuring that their decision-making processes are not just black boxes, but understandable entities that can be scrutinized. As we explore these complexities, we must also consider the implications for various industries. In finance, for example, automated trading systems have already shown us the risks associated with algorithms making rapid decisions. The flash crash of 2010, where the stock market briefly plummeted due to automated trading algorithms, serves as a cautionary tale. In the realm of logistics, AI-driven supply chains optimize efficiency but may also create vulnerabilities if a critical error occurs in the system. When we envision a future where AI governs legal agreements, we must ask ourselves, who benefits and who loses? Will the efficiencies gained by corporations outweigh the risks posed to individuals? The balance between automation and oversight is delicate and requires careful consideration. As we stand at this crossroads of technology and ethics, we must navigate the terrain with caution. Could we create a future where AI enhances our legal agreements while ensuring that human values and intentions remain at the forefront? As we ponder these questions, it becomes clear that the integration of AI in transaction management is not just a technological advancement. It is a societal shift that demands our attention and responsibility. The choices we make today will shape the ethical landscape of tomorrow's transactions, defining what it means to trust an algorithm with our agreements.